Hello and welcome to Chapter 7 of our online review program. Today we're going to be covering sales revenue and receivables and also a bit about cash, like bank reconciliations. So let's get into the chapter. So there's a couple of questions we're going to be asking today. First one is, why do businesses make sales on credit? So why does a business even make credit sales? How do we account for accounts or sales we've made on credit that we're not actually going to collect? So how do we deal with that? And finally, we're going to talk about bank reconciliations today. So let's just review from our previous lectures what the criteria is for revenue recognition. So if you remember, the first criteria is that the risks and rewards were transferred. The second is that you do not have any more control over the goods, so there's no more managerial control, so there's no control. The third is that revenue can be measured. The fourth criteria is that the economic benefits will be likely to flow, so basically that you are likely to be paid. And finally, the fifth is that the costs for the transaction can be reliably measured. So these are the 5 criteria of revenue recognition. But when we're dealing with a service, it's very easy to figure out the point when revenue is earned. It's when you provide the service. But if you're actually selling goods, when is the exact moment that control passes over? When is the moment that the sale takes place? So in order to figure this out, we have 2 different possibilities. And so I'm going to teach you these 2 terms: FOB destination, so free on board, right? So FOB means free on board. So there's 2 possibilities. The first is FOB destination, and the second is FOB shipping point. And this is the moment that control passes over. So under FOB destination, control of goods would be transferred at the destination. So that means the client's factory. So at the client, right? It's at the destination that control passes over. On the other hand, the other possibility could be FOB shipping point. And here, it transfers at the shipping point, so that could be your warehouse. So this is important for a few reasons. If it's at the end of the year and you're trying to figure out if a sale was included in this year, at the very end of the year, or if it was included in the next year's sales, you would have to be very careful to take note of what the actual policy is when we recognize revenue in our company. So this is an accounting policy, and you would actually have to tell, did the goods ship out? Did they not ship out? It also is important for determining liability for the goods if they're en route. Is it still yours? Is it already the client's? So these are all things to think about. So let's talk about sales discounts, returns, and credit card sales. So in general, sales to consumers are primarily made either by cash or by credit card. So there's a couple of advantages to accepting credit cards. So why don't you stop for a moment, pause the video, and think about it. What is the advantage of a company actually accepting credit card sales? So the first advantage is that it would increase customer traffic. And this is more true today than before because a lot of people don't really carry cash. So if you're going to sell goods and you accept credit cards, it would increase the number of people who are willing to purchase from you. It also helps your company out because you can avoid having to provide credit to your customers. You don't need to provide credit because the credit card company will do that for you. So they'll take care of the record keeping. They're the ones who have to take on the cost if there's a non-payment. They're the ones who have to deal with the risk. It also lowers losses due to bad checks, which is not very common nowadays, but it is another reason. It also avoids your losses from fraudulent credit card sales. So if there's a fraudulent credit card sale, it's the credit card company who needs to shoulder that cost. So avoids costs of fraudulent credit card sales. And finally, you receive money faster. And so if you provided credit to your customers, right, if you just gave them an invoice saying, oh, pay us within 30 to 60 days, you would have to wait for that client to pay you. But if you accept credit cards, let Visa or MasterCard handle that. They're the ones who are going to have to wait to get paid, but you would get paid by direct deposit from their credit card company. So in exchange for all these benefits, we have to pay fees to the credit card company, right? As the merchant, we pay fees. And this is called a credit card discount. And we're going to get into the journal entries of that. So what would that actually look like in terms of journal entries? So let's write that out. So normally, this I'm going to write out for you. If you normally made a sale, right, you would debit cash. So we're debiting cash. Just an increase in assets. And we would credit sales revenue, which is an increase to shareholders' equity. But in a case where we're going to actually have credit card sales, right, we would actually debit another account as well. So we would debit a credit card, either discount, or it could be credit card fees. So that's an increase to expenses. And then we would credit sales revenue. That's an increase to shareholders' equity. And so generally, the credit card discount would be about 2 or 3%. So in general, cash would be, let's say 98%. This would be 2% of the total sales revenue, right? So remember, your debits have to equal your credits at all times. So this is what it would look like. Let's talk about sales to businesses. So sales to businesses are actually often made on account. So on account, it's by credit. We're offering credit to our clients. So generally, to facilitate faster payment, we would actually offer a sales discount to our customers when we're selling to a business. So we'd offer a cash discount if they pay within a certain time period. And if you offer a discount, it makes you more likely to be paid than another business that doesn't offer such a discount. So it makes it more likely that you will be paid before the company runs out of money. Let's say they have $10,000 to pay off their debts this month. They would be more likely to pay off the debts that offer a discount than the ones that do not. So to help you understand this, there's actually a very important term, 210 N30. So what does this mean? 210 means that you would get a 2% discount if paid within 10 days. So we're telling our clients, right, let's say they owe us, $1,000. This is just a number I'm coming up with. If you pay us within 10 days, you're going to get a 2% discount, so you're only going to have to pay us $980. And the N30 is net in 30 days. So this means if you pay within 10 days, you get a discount, we tell our clients, and if you pay within 30 days, you just pay the $1,000. If you pay in more than 30 days, then interest may start to accrue depending on the terms. But sometimes you'll see situations where the terms could be something like, 110 and 20 or and 60. It's important just to understand that these are credit terms and it can change, but the most common is 210 and 30. That's what you're going to see most often. And finally, we have sales returns and allowances. So this is a reduction of sales for returns Or we may actually create an allowance account, which I'm going to get into in a moment, for goods that are unsatisfactory. So I'm sure a lot of you have worked in retail at one point, and you understand, how sales returns work. But what we do when we record it is we don't actually reduce the sales revenue. We actually just create a contra revenue account called sales returns. And we also may create an allowance account, which is a provision where we recognize the expense right away, but we create this allowance in case we have any unsatisfactory goods. So what I've done here is I've shown you what the top of our income statement, right? So our statement of earnings would look like. So statement of earnings, and just pretend that the rest of the title is there. So we would start off with our sales revenue, and so this here is our gross amount. This is our total amount of sales. And these are not actually contra asset accounts, so pretend it doesn't say that. But if you look here, we start with the gross amount, and each of these, right, so our credit card discount, our sales discount, and our returns and allowances are each going to decrease that gross amount. So it decreases it. And finally, that will give us our net sales revenue. And then after that, on our income statement, right, we'd have our cost of goods sold, and we would go all the way down. So it's just important to understand that we don't actually decrease sales revenue directly, but we create separate accounts to record it that will then offset that gross sales revenue account. And the reason we do that is we want to provide, if you recall, in the entire point of financial accounting and financial reporting is to give as much information to the user of the financial statements. So it's important for the user to see, okay, well, how many returns are they getting? That's very important. If a company is returning 50% of their sales, that's a big deal. So it's important just for users to be able to understand what's going on in the company. So now that we've covered the basics of sales revenue and applying the revenue principle, we're going to actually talk about accounting for bad debts, which is the big part of this chapter. So customers will often offer their customers the option to purchase goods on account or on credit, as you recall. And the reason why they do this is because it will increase their sales, right? Most companies don't carry huge amounts of cash on hand. So by offering customers the ability to purchase on credit, you could increase your potential sales. But this does have a cost. It does have a price. And what is that? It's the risk of non-payment. It is possible that we will sell customers goods on account and they can go out of business, or they'll just refuse to pay us, or they could take a very long time to actually pay us. So I'd just like to emphasize, though, that it's very important. We are not talking about credit cards. So this is not Visa or MasterCard that we're talking about. We're talking about if the company itself is offering credit, meaning that as a customer, we will give you the right to purchase without paying right now. We're the ones who offer the credit facilities, not an outside company. So this is the company offering credit. So because we're offering credit, we're the ones who take on the risk. So the way that it works with bad debts is we actually base the bad debt. So we base the bad debt on an estimate of uncollectible accounts. So this is the allowance method. So the first step in doing so is you would estimate and record the bad debt expense. So what does that mean? You would estimate it. Let's say the company has $100,000 of accounts receivable. So we have given our customers $100,000 of credit, and based on past years of statistics, based on what's going on in the economy right now, based on all these other factors, management will make an estimate. So let's say we'll estimate that for this scenario, we'll say 3% of AR, accounts receivable, will not be collected. So based on this, we will make a bad debt expense. So 3% of 100,000 is $3,000. So we will estimate this year of our 100,000 accounts receivable, 3,000 will not be collected. And so we will actually record a bad debt expense at the end of the year of this $3,000. We will recognize the expense immediately before we've written off any accounts. So it's important to realize at the end of every year we do this, at the end of every period, recognize that expense, and then throughout the following year, whenever a specific account, right, so whenever we're going through this 100,000 and there's one that we now can assume will not be collected, that specific account is written off by using this allowance we have created. So we're going to go through the journal entries for that. So let's take a look. So as I said, we're going to look at the journal entries. And just before we jump into the journal entries, we're just going to go one last time through the definition of the important accounts here. So bad debt expense is done at the end of the year, so it's an expense. And at the end of the year, so it's recognized at the end of the year, and this is recognizing the expense for all. So this is the aggregate for all estimated uncollectible accounts. And I'd like to emphasize that this is an estimate that management makes. So it's very important. It's an estimate. We don't know for sure what we're going to collect or not going to collect. If we knew that certain accounts were not reliable accounts, we just wouldn't offer them credit. So this is an estimate of what we're not going to collect. And we also have another account called the allowance for doubtful accounts. And this is a contra asset. And if you remember, we talked about contra accounts in a previous lecture, and the purpose of a contra account is to offset the balance of another account. So it only exists to reduce another account. So it's the contra account for accounts receivable or trades receivable. And so this is the allowance we have created. We have recognized an expense at the beginning of the year, at the end of the year, and we assume that all these accounts are going to be uncollectible, and we use up this allowance whenever a specific account is uncollectible. So how do we know that an account is uncollectible? So how do we know? So, it could be that we're trying to call and we can't get through to them for like 6 months. We're trying to call and we find out, that they've, left town, or it could be that they're bankrupt, or maybe they just tell you we aren't going to pay. There's obviously steps that you can take in such a case, but basically you use up the allowance when you know for sure that a specific account cannot be paid, while the bad debt expense is used at the end of the year to increase the allowance. So this is used to increase the allowance. So let's take a look at how we actually record each of these steps. So this is at the end of the year. If you recall, step 1, we make our estimate. So what we would do is we would debit bad debt expense for however much money, and we would credit the allowance for doubtful accounts, AFDA. So bad debt expense is an expense, so we're increasing that, and AFDA is a contra asset that we are increasing. Now during the year, when we have a specific account that we're going to write off, we do so by actually debiting AFDA. So we decrease this contra asset, and we would credit accounts receivable. So we would actually write off the specific account. Now let's say we've been trying to call somebody for 6 months, we write off the account, we assume that they're not going to get paid, we write it off, and then a week later or a month later, they call us and say, oh, I haven't checked my voicemails, pretty irresponsible of me, but I'm actually going to pay you. So what do we do in such a case? Well, there's 2 steps The first is we have to reverse. So you would have to reverse writing off the account. So you just do the opposite of what you did to write it off. So you debit the allowance for doubtful accounts. Sorry. You debit accounts receivable. So we increase our asset again. And we credit the allowance for doubtful accounts. So we're going to add it back. We're going to add everything back to how it was before it was written off. So the first step is to reverse it. And then the second is we actually collect the cash. So we debit cash. And we credit accounts receivable. So these are the journal entries you need to know for this chapter. And this here will be step 2. So step 2, when you write off specific accounts. So it's just very important to remember that this is done at the end of the year, this is done throughout the year, and this is whenever you have to reverse. So what do these actually look like as T accounts? So this is actually one of the most important parts of the chapter, to know how to do the T accounts for AFDA, the allowance for doubtful accounts, correctly. Because in order to figure out what your bad debt expense is, you're going to have to understand what your AFDA is at the end of the year and what you want it to be. And I'm going to explain what I mean by that. So here we have our T account for the allowance for doubtful accounts. And let's assume that it's a new company, right? So it's important to note that when a company begins, they do not have any balance in their AFDA. So they began with nothing in their account. And throughout the year, let's say they wrote off individual accounts. So they would debit accounts. So they had a write-off of $4,000. Now at the end of the year, right? So at the end of year 1, so this is year 1, and they have a debit balance of $4,000. So that's actually a negative, right? Because AFDA as a contra asset normally has a credit balance. Now, if you recall, the first step is we need to figure out or estimate what our bad debts would be. So let's assume that as a company, right, we'll go back to what we had $100,000 of AR, so our AR is equal to $100,000, and we estimated that 3% would be uncollectible. So that gives us $3,000. This is our desired AFDA. We want our allowance for doubtful accounts to be $3,000. So what you would do is you would put 3,000 here. So this is what we want to have, and this is where we are at the end of the year. So in order to get there, we would have to do a journal entry here that would make up for the debit balance of 4,000, right? This is a debit, and get us to a credit of 3,000, right? So we're not just subtracting 1,000. You can look at this debit balance here as being negative 4,000. So in order to get there, in order to figure it out, right, so we start off with 3,000, and then we need to subtract from that, right, minus 4,000. So that actually gives us $7,000, and that is what we want here. So the journal entry that we would write is debit bad debt expense and credit AFDA for $7,000 each. So that makes up for the write-offs we had of the past year, and it also gives us the desired balance for our upcoming year of 3,000. So let me ask you, if let's say instead of a balance of instead of a write-off of 4,000, let's say we had a write-off of 2,000 over the year. So that would give us an ending balance of 2,000. How do you think that would affect our ending our end of the year adjusting entry to set our allowance for doubtful accounts. So what we would do is instead of 4,000 over here, it would be $2,000 as our ending balance. So that would give us a required entry of $5,000. Now, we're not always going to end with a debit balance. It is possible that we'll end with a credit balance. So I'm going to write out what that would look like. So this was a case that I drew here of a new company, because new companies start with a zero balance in their AFDA. So let's try that again, but with an ending credit balance. So let's say we started the year with a $10,000 credit. So this is our beginning. Then we had write-offs of $4,000. Actually, let's just say let's say it was a write-off of $8,000. So that would give us, at the end of the year, a balance of $2,000. So this is our ending balance. Now, assuming that we still have a desired ending AFDA of 3,000, what do we need to do? So we put the 3,000 here, and this is our desired AFDA. So in order to get there, just be 3,000 minus 2,000, right? We have our ending balance. So $1,000, that is our required entry. So we would just debit bad debt expense by 1,000, and we would credit AFDA by $1,000. So I hope that that makes that clear for you. And bad debt expense, you're just going to use that like a normal expense T account. So I'll just show what that would look like. So bad debt expense, and you just put your expense here during the year. And then if you recall, at the end of the year, we do our closing entries, and we would clear that out at the end of the year, and we would end with a zero balance. And so we discussed up till now the allowance method. So the allowance method, where it would just be a percentage of your total accounts receivable. So that's one possible method, but it's not the only one, because not all accounts are equal, and we should take into account how long we've had the accounts sometimes when estimating it. So another option is the aging of receivables method. And so I'll show you what that would look like. So the thing to remember with the aging of receivables method is the whole concept behind it is that the older an account is, the less likely you are to collect. So let me ask you, for example, if you had two accounts, one was 15 days old, right? So you made the sale 15 days ago and you haven't been paid yet. Or you had one that was 4 years old and you hadn't been paid yet. Which do you think is less likely to pay you? Of course, it's going to be the account that you've had for 4 years. So in order to calculate this, companies will actually create a schedule where they will write out how long they've had the accounts for, and based on the date of each account, right? So depending on which one, there's going to be a higher risk of non-collection. What I've done here is I've actually created a template of an aging schedule for you. So what the company would do is they would list out their customers, right? We have customer A, B, and C, and they would then write out all the receivables for each customer based on, the ones that are not due yet, right? So within 30 days, let's say, of it being given. And then it would start to record how past due they were. And based on how long they've been past due, the longer the receivable is outstanding, the more likely it is to not be paid. So let's say, for example, receivables that aren't due yet, we would assume 1% would be uncollected. 1 to 30 days past due would be 3%. 31 to 60 would be 6%. Ones that have been 61 to 90 days is 10%. And finally, those that are more than 90 days past due would be 25% chance that they would not be collected. Now, the numbers I've come up with here are not hard rules, and every company will have their own numbers based on their estimates, based on the past, based on the customers, etc. So I'm just going to write out a couple of accounts just for you to get an idea. So let's say customer A has $1,000 that are not due yet, and customer B has nothing that is not due, and customer C has $500 that is not due yet. So we have $1,500 that are not yet due. So 1% of that will be $15. Now, for those that are, let's say, 1 to 30 days past due, let's say only customer B has $2,000 that are, 15 days past due. So the total would be 2,000 times 3% would be 60 that's uncollectible, etc., etc. So you would just go down the entire schedule and you'd write out each customer's accounts and how much they're past due, and you would sum up at the end the total from customer A, customer B's total, so this is A's total, B's total, C's total, and then you would put your total accounts receivable here, and you would add up all your estimated uncollectibles here. So I'm not going to fill out the entire thing, but I just want you to understand that there's two methods, right? So method 1 is the allowance method, and 2 is aging of receivables. And the difference is that the aging of receivables, they take into account how long a debt has been outstanding, and that'll increase the likeliness of it not being collected. So how are they reported in the financial statements? So bad debt expense goes on your income statement. So let's say you have your statement of earnings, and then you'd have your sales, have your cost of goods sold. That would give us our gross profit. And then we would have operating expenses, and one of them, for example, would be bad debt expense. So it would go over here, and this would decrease our income, right? So higher expense means lower net earnings. And allowance for doubtful accounts goes on our balance sheet. So we have our balance sheet, and under our current assets, we would have, we'd have cash, accounts receivable or trade receivables. So it would be however much. Then we would put AFDA, so less our allowance for doubtful accounts, and that would give us our accounts receivable net, our net receivables. So let's take a look at this because it's important to understand. So this is our gross accounts receivable. This is everything that our customers owe us. AFDA is what we're saying, this is what we believe or we estimate we will not collect. Out of the aggregate of all of our receivables, we will not collect this amount. So we have our accounts receivable net, and this is what we believe that we can reliably collect. So when we write off a specific account during the year, right? So if you remember, the journal entry to write off an account is we debit AFDA, so that decreases AFDA, and we credit accounts receivable, decreasing that too. Well, accounts receivable goes down and AFDA goes down, but they go down by the same amount. So they offset each other. So when you write off an account, so a write-off does not change your accounts receivable net. The only thing that's going to change your net receivables is at the end of the year when you create the bad debt expense to increase your AFDA. But writing off a specific account does not affect your net receivables. So now that we've gone through that, let's take a quick look at bank reconciliations. Usually it's not a huge part of your exam, but it's very important to understand the logic behind it. So what is a bank reconciliation? In a bank rec, we are trying to verify the accuracy of the bank statement, right? So a bank statement is what the bank sends us at the end of the month, and they say this is how much money you have in your account, and these are all the transactions you've done. And the cash account, right? So on our balance sheet, so this is our balance sheet, and the cash accounts of a business. So we want to make sure that the bank statement equals our cash account, or we at least want to reconcile it and see why are there differences. Because it's possible that they're not going to be the same, because some documents either didn't reach the company yet, or they didn't reach the bank, or maybe we have transactions that are still pending, right? We've maybe written a check and we've recorded the cash as having left our balance sheet, but the bank hasn't deposited the check in somebody else's account. So it's possible that at the end of the accounting period, there will be differences. So the entire point is to see why are there differences, and it should be very easy to match it up. So this is what it would look like. At the end of the period, you would look at what is the cash balance on our books, right? So we're going to look at our balance sheet. And this side here is the cash from our bank statement. And this here at the bottom should be equal. And so if we go through these changes, we will get the same results. So the possibilities, right, are that there are collections that are made by the bank, right? So collections by the bank that we don't know about yet. So we would add that to our cash balance, right? Because we just didn't record that we received the cash yet. So we would add that. We would then subtract any amount for NSF, so insufficient fund checks. So maybe we wrote a check and we got charged for writing a check when we didn't have cash. Or maybe we had service charges from the bank that we didn't know about. So we would subtract these amounts, and we would also adjust for any company errors, right? So let's say we just for example, we said we spent 250, but we recorded 520. So you would just adjust to fix that. So that could either add or subtract. And that will give us our ending correct cash balance. Or if we're looking at our bank statement, we would add deposits in transit, right? Because if you deposit a check, it's not necessarily going to get added to your bank account right away. But you would have recorded on your accounting records that it was added right away. So you would add any deposits that are currently in transit. And you would also subtract any outstanding checks. And just like with our accounting records, there could also be mistakes on our bank, on the bank's end. So we would adjust for that, and that would give us the correct balance. So try it out. There's a couple of problems in your book. I recommend you look at them, you try it out, and in past exams, on some of the multiple choice questions you have them. So try it out a couple of times, and if you just remember this general format and you understand where things are supposed to go, it will be quite simple after practicing it a few times. So let's end off today's review session by actually looking at some ratios. So we'll start off today by looking at the gross profit percentage. You may have heard of this before, gross profit percentage. What is your gross profit margin? So what you do to calculate this, so gross profit percentage, so you take your gross profit for the company. If you remember, gross profit is your sales less your cost of goods sold, and we divide that by our net sales revenue. So for example, if a company had gross profit of $350,000 and they had net sales revenue of $500,000, they would have a gross profit percentage of 70%. So what this means is that for every $1 of sales, they will have 70 cents of gross profit to pay off the rest of their expenses, their operating expenses, their financing costs. And of course, as always, this is like a profitability ratio, so a higher number is better. You always want to have a higher ratio for gross profit percentage. And this is a very important ratio that analysts look at, because if you have very low gross profit, you're going to need to sell a lot to make up for it. Whether this is good or bad, of course, it depends on the industry. A company like Walmart has a very low gross profit percentage, but they sell a lot of products, so it makes up for it. Well, a company that sells, high-tech products may have a higher margin. So it really depends on the industry, as always. The next ratio we're going to look at is the receivables turnover ratio. And so this is net credit sales, although often we don't actually have access to how many credit sales a company had. So if you don't have that, use net sales revenue, just their total sales, and you can just assume it was on credit. So it'll be net credit sales divided by average, and if you remember, average is beginning plus ending divided by 2, net trade receivables, or accounts receivables. So average net trade receivables. So let's say, for example, our net credit sales for the year was $1 million, and our average trade receivables for the year was $100,000. So that would give us a receivables turnover ratio of 10. So what does this mean? It means that we collected, right? We turned over our receivables 10 times in the year. So with this, a higher ratio is good because it means that you're doing a good job at collecting your receivables. You don't want your receivables to be outstanding too long. You want to constantly be collecting and in a prompt time period. And finally, we have the average collection period. So that's 365 days divided by our receivables turnover ratio. So we'll just use the ratio that we had last time, 10. So we'll divide it by 10. And that gives us an average collection period of 36.5 days. So what this means is that on average, it takes us 36.5 days to collect our receivables. And so for this, we want a lower ratio because we want to be collecting it in as little days as possible. And as always, I'll mention this every time, we don't go super into detail about the ratios. We really recommend you go into the book and read up on your own about the ratios and practice them and memorize them on your own. So that's going to be it for today. We hope to see you in a future review session, and as always, best of luck.